the various platforms. So good evening and welcome to this live Ask Me Anything About Property Investing with myself, Saj Hussain. I'm here every Monday evening at 8:30 p.m. ultimately to help you get further faster in your property investing journey. I've been investing in property for about 15 years. I've been in business for myself for nearly 30 years. And really, I'm using my time and skill and experience to help you progress in your property investing journey. So lots of different strategies I've done over the years. Do I know everything there is to know about property? Absolutely not. Certainly never claimed to do to be the person that knows everything. I'm always learning and improving my knowledge, but I've got a huge amount of knowledge that I'm happy to share with you and help you with. So whichever platform you're watching on, just say a quick hi first. Let me know you can see and hear me okay. We have a slight different setup on the tech this evening. Just make sure the sound's working, the picture quality is okay, and we'll get started in just a moment with questions. So if you've got a question for me this evening, make sure you put it in the comment section on whichever platform you're watching. We are live streaming on Facebook, YouTube, LinkedIn, Instagram, and Twitter. So whichever platform you're on, pop a question in the comment section and we'll have it pop up on the screen in a little while, and I'll just answer them in the order that they appear. So if you've got a question, make sure you ask it nice and early. Don't leave it too late in the evening, because as we get closer to the end of the evening, often we find people start asking questions at that time, and there isn't enough time to answer all the questions. So we'll do as many as we can this evening. As I said, I'm here for about half an hour. I'm here every Monday evening. Bearing in mind, we can do like an overview of question answering here. It's quite difficult to go into deep with specific questions, because really it's about understanding more about you and getting more context. Sometimes it's not so easy to be able to answer a question in that way. So prior to this session on a Monday, I have a group call with my inner circle mentoring group. So I have a mentoring group where we do a group call on a Monday, and that's more interactive, where we're asking questions about specific issues and challenges. Because it's two-way, I can ask the questions and get clarity. We can go much deeper here. What I try and do is answer questions at a higher level for you, but hopefully give you enough information to help you move forward with that. So as I said, we're here for about half an hour. We'll get started with the first question in a moment. My lovely assistant will flash up on the screen, and then we'll get started in just a moment. Make sure you can hear me okay. Okay, great. So the first question is on YouTube from Property Seller. Hi Saj, a house has asking price of 200,000 and needs 25,000 refurb. The street had 200k sales last year. What price would you offer to ensure that you're getting this well, it says BMW, I'm assuming you say BMV, good cushion due to COVID? So that's it's a good question. So if the asking price is 200, previously property prices that have been achieved have been around the 200 mark. So you could say that's a fair market price possibly for the property. But of course, you said it needs some money spending on it as well, it needs about 25,000. So the question that I would ask, does it need 25,000 spending on it for it to be worth 200,000, or does it need 25,000 spending on it for it to be worth significantly more? So that's one question you need to just take into consideration, first of all, in terms of what will be the value after spending that 25,000. Because sometimes you see people asking for a certain price, saying, oh, the property's worth this because other properties in the street have sold this, but they may have already been in very good condition. You have to spend money on this one in order to get it into a much better condition. So that's something you need to take into consideration. Then the other thing is, in terms of the market right now, let's say you're doing some work on that. As you mentioned, 25,000, it could be a couple of months work that you're doing, maybe just a few weeks of work that you're doing on that property. And then you want to think about what's the end value, whether you're going to refinance it, whether you're going to sell it. But the thing is, we don't know what the market will be like in a few months' time. We don't know what the market will be like in 3 months' time, in 6 months' time, in 9 months' time. Many people have got an opinion of what will happen, including myself, in terms of what we think will happen. But the reality is nobody knows for sure what's going to happen to the property market in the coming months. So you have to have a plan B in mind when you're doing a strategy like this. As I said, whether you're going to remortgage at the end or whether you're going to sell the property, in terms of how that might impact you. So for instance, if you're going to sell the property and let's say the prices have dropped, then it might take you much longer to sell the property. You might not be able to get as much as you want for it. How much, we don't know. This is where you've got to think about what you might be comfortable with. On the other hand, if it's a case of you're looking to remortgage the property, and let's say the market's much slower, then at the same time, you might get a lower valuation. But when the surveyor comes out, you might think, well, actually, the property is not worth as much right now. It's taken much longer to sell, so they're worth less. And the remortgage figure isn't quite what you were expecting as well, meaning you get less money out of the property. So your question about what percentage, I guess it's almost like saying, what's the lottery number? It's very, very difficult for anybody to guess that in terms of where we're going to be. But what you want to do is apply some logic based on what we do know. What we do know is the market is going to be going through some change. It's going to be turbulent. We don't know exactly what's going to happen. We think the market will probably slow down and crash. That's my view, unless the government steps in and puts some additional measures in to support the market, as it already has done with regards to stamp duty holidays, with regards to talk of 95% mortgages to first-time buyers, and of course all the other support that's been offered, say for example like furlough, loans and grants for businesses. This kind of support can prevent the property market crashing out. Now, some people talk about the market might drop 5%, some people say it might drop 40%. We don't really know. In Birmingham, when the market crashed previously during the credit crunch about 12 years ago, we saw about 25-28% drop in price, and that was quite extreme. We don't really know how much it's going to change. You've just got to do these transactions with that in mind, that if it changes, how is it going to impact you, and what are you doing to protect and cushion yourself? So I hope that helps. Hope that gives you some insight. Fortunately, can't give you a solid answer on that question, but hopefully it gives you some insight. So our next question is from TM, also on YouTube. Hi Saj, I'm looking to invest in property that didn't sell at auction. I tried to get a mortgage on it, but mortgage lender declined because it's uninhabitable. Now I'm thinking to go bridge. Am I on track? So based on what you've just said to me there and shared with me there, TM, you'd be looking at a property that hasn't sold in the auction. So you've tried to buy post-auction, after the event. And you've applied for a normal mortgage on it, but that's been declined because when you apply for a buy-to-let mortgage, which I'm assuming is what you've done, with a buy-to-let mortgage, they're expecting that property to be ready for somebody to move into it to start paying you rent. If the property is not ready to do that, then what you have to do is look at what is it that needs to be done to make it habitable. Now, it could be a number of things. It could be lots of, for example, little things that just mean that need putting right on the property. It could be something significant, like, for example, it hasn't got running water. A common one is on repossessions. You see sometimes, like somebody's taken the kitchen out, so they've been repossessed, and because they've literally lost their shirt off their back when they leave that property, they take the kitchen with them, and so that means nobody else can move into it and start living in it because it's got no kitchen. So these are examples of what can make a property uninhabitable. Also, another one that gets missed quite often is the EPC rating isn't sufficient. So it should be a minimum, I think it's an E at the moment, a minimum EPC rating for lettings. So if you're letting a property out, it needs to meet a minimum standard, and if it's below that, it's inadequate to let out right now. So it could be something as simple as fixing that. So first thing is establishing what is it that's making it uninhabitable. Let's go back to the example of the kitchen. Let's say there's no kitchen in there. Now, you'd think to make it mortgageable, all you need to do is put a kitchen in. So if your lender is going to give you some clarity around what is it that they're not happy about, let's assuming it was the kitchen, what you can do is go back to the seller of the property and say, look, I'm willing to exchange contracts with you, and we leave the completion open to say, let's say 2 months, for instance, as long as they give you access to the property to be able to do some rectification work, such as being able to fit a kitchen. Should be no skin off their nose. They probably agree to that. What that means is now you've committed to buying the property, you've exchanged contracts, but your lender will give you a mortgage as long as the property becomes habitable. In between the exchange of contracts and the completion, you go in and fit a kitchen in the property, and now it becomes mortgageable. So now you can continue with your buy-to-let mortgage. Now, let's say none of those things are possible. There's something else. There's a much bigger issue. Then the bridging option is the most common thing. Often bridgers will lend based on what they think is the value, based on the 70-75% of that figure. And you've got to put the rest of the money in terms of deposit and also the works required to get it up to speed. Now, bridgers can be quite ruthless in terms of the arrangement. So you've got to be absolutely sure that you can exit off it. And remember, a bridge is exactly that. It bridges a gap between 2 points. So you're coming onto this property transaction, but you need to be able to get off it on the other side. The way you'd get off it is normally remortgage onto a buy-to-let mortgage. So you need certainty that you can fix the problem and come off that bridge if you are using bridging as a method to be able to buy the property. So I hope that helps. I hope that gives you some pointers there. Thank you so much for the question. Our next question that we have, actually, just before we get that next question, give me your thoughts on the tech. Is this layout okay? Is the lighting okay? Is the sound okay? We're just trying a few different things and see what works well and what produces the best possible picture. I think last week, one of the challenges we had, the camera was way too far back and it didn't really give us a great picture. So give me your thoughts on the setup and how this is working. So I appreciate that. Thank you. So our next question, if we get that back up on the screen, is from Vivian, also on YouTube. Can you tell me if university is beneficial for me? Want to study property development, and I think when I enter the real estate business, it would help me a lot. What's your opinion? Vivian, thank you for the question. I'm assuming you're at that stage in your life where you're thinking about going to university. And funnily enough, this is a question a few people have asked me over the last few weeks. And I guess it's that time of the year where people are making those decisions around continuing their academic studies and maybe going on to university and also have an interest in property. Now, first of all, I'll never in this situation would suggest to you what you should do. What I can tell you is what I would do if I was in your shoes. That's probably the best way I can answer this question for you. Now, I'm of the opinion that education is very important. When we're looking at university education, we have to look at the context of what is it we're trying to achieve at the end. So if by going to university for 3 years, we intend to come out and then buy property and renovate it and flip it and build a portfolio, then we have to ask ourselves, what was the point of going to university? What have we learned that we couldn't have learned on the job by actually getting started now and be 3 years ahead rather than waiting to do the theory and then starting to implement it in 3 years' time? So, that would make me think maybe it might not be the right route. And I said, I think education is important. In fact, I have 2 degrees. I've been to university to do my first degree in business and a second degree as an MBA. And, if I had my time again, I'd probably just go straight into doing property development if I ever had that opportunity to restart my life. And over the last 30 years, I've been working for myself. And I feel I've learned a lot more by actually doing stuff than the theory. Yes, you need some theory, but the other, at the same time, there are certain roles in life that actually going to university is going to be beneficial. It's going to be a must to help you to get you to where you need to be. So, for example, like a doctor, for instance. Now, in property, it may be that you want to go down the academic route, you want a formal qualification, you want a professional qualification. For example, it might be a chartered surveyor. And for that, you would also probably go to university as well. So I don't know enough about your course, but that's my thoughts. I think if your intention at the end is to finish university and then go straight into developing property for yourself, then what is it you're going to get from university? If, on the other hand, you want to learn about the world of property development and then go work for some bigger developers and be a piece of that bigger pie, if you like, then I'm sure there are probably some advantages in that. So hopefully that's given you some insights into my thinking on that topic. So our next question this evening is from Sagantan, I think. My apologies if I butchered the pronunciation of your name there. I am terrible with pronunciations. This is also on YouTube. So where's everybody else today? Where's everybody on Facebook and LinkedIn and Twitter and Instagram? We seem to be only getting questions on YouTube this evening, but hey, that's good. So can you tell me if university is beneficial? Is that the question we've just done? A different question. It's another similar question. Can you tell me if university is beneficial for me? Want to study property development, and I think when I enter the real estate business, it would help me a lot. What's your opinion? Any other routes? Yes, just to add on what I already answered in the previous question, I think it was for Vivian, which is that if you're doing property development, you want to develop property, you want to invest in property, you want to get hands-on in building your own property business. If I was in that position, what I would do is go straight into property business or working for somebody who's in that sector right now, a small developer who I can learn from, as opposed to going to university to study the theory for 3 years. That's just my personal opinion. So our next question, also on YouTube again, is from Arif Khan. Hi Saj, how much deposit we need for a property to buy under a company's name? Thanks. So I'm making some assumptions here, but let me air what I think those assumptions are. You're purchasing investment property, i.e. buy-to-let property, in a company name as opposed to your own name. And the reason many people are choosing to do this more recently is because of taxation, Section 24 as it's known, which means that actually it's now much, much more expensive keeping property in our personal name than it is in a company. And this is a bit of a generalization because it depends on your tax brackets that you're in as well and overall your tax position. But generally speaking, the trend tends to be towards purchasing investment property now in companies. Now, many years ago, sort of going back 6, 7, 8 years, getting a mortgage, a buy-to-let mortgage in a company was a little bit of a challenge because there wasn't very many products. But now as the market's evolved and more people are starting to buy property in this way, the lenders have produced products, more and more products and competitive products for us to be able to buy property within company names. So it's the same usual structure, generally about a 75% loan to value mortgage means you're putting 25% down, pretty much the same as though if you purchased it in your own name. The difference being your rate is probably a little bit higher in the company as it would than it would be if you had it in your own name. So I hope that helps with that question. So our next question will appear on the screen in a moment. Aha, here it is. So next one's on LinkedIn from Saj Ahmed. Great name, Saj. Works well and your voice is clear. Oh, thank you very much. That's just let me know you can see and hear me okay. So what's the next question that we have? So next question's on YouTube from Jamie, Jamie S. Hi Saj, how much percentage discount could you expect to attain from purchasing a property with cash and a property that is being sold by an administrator? So a property that you're paying cash for and it's being sold by an administrator. Now, the role of the administrator is somebody in, it might be somebody in bankruptcy, in liquidation, it might be assets that have been sold off or for the Crown or whatever it might be. The administrator is effectively dissolving assets, liquidating them to be able to repay certain debts. The role of the administrator is to get the best possible price they can for the who was the owner of the property to be able to clear their debts. That's essentially what the administrator is doing. The reality is the administrators will sell the properties generally at a more attractive figure because they want it moved quickly. They don't want it hanging about. They want the deal done. They want the money in the bank. And the administrator gets paid their fees on an hourly basis, how much time they spend on getting this done. They just want to get it wrapped up. They want the cash in the bank so they can get their fees paid. Now, some people may not want to hear this, but the reality is there are sometimes relationships that exist between administrators and people that may be purchasing assets from them, and there can be some deals that are done. I'm not saying everybody does that, but unfortunately it does happen. And if you're buying from an administrator, you're really just negotiating with them what's the best possible price. It ultimately comes back to supply and demand. So right now the market is very strong. There's very little stock out there. So things are selling very quickly. So if I roll the clock back, say, 12 years, just around the time of the last recession, when the market had crashed, there was an abundant amount of stock on the market. There were very few buyers. And so driving what was already a low price down even further wasn't too difficult. So earlier on, I talked about when the market crashed in Birmingham, we had a drop of around 25%. So let's say it was a £100,000 house. The values had dropped to 75,000 because the market had crashed out. So those that were buying, some were paying 75,000, but some were driving the price down even further because 75 was then the current value and you were getting a discount off that, maybe another 10, 15, 20, 25% even off that price. So quite a significant difference in the price. because it all comes back to supply and demand. In the same way, if the administrators have got plenty of people right now that will purchase from them very quickly and they're in a strong position, they may not be too flexible on the price. If, however, if there's something a little bit difficult or awkward about that property, the transaction, the way it's structured, or complications, and they want it shifted, they'll negotiate, and I will try and negotiate with the best possible price you can. And of course, administrators, as with anybody else that might be selling, it's about talking to them about trying to strike a deal that's fair. If you're looking for 10 or 15% below what would be the asking price, I think that would be a reasonable ask, but it doesn't mean you're necessarily going to get it. So Jenny, hope that helps with that question there for you. Bottom of the screen, we've got our various social media handles. Make sure you connect with me on these different platforms. Ping me your questions there as well. I'm on Facebook, YouTube, LinkedIn, Instagram, Twitter as well. So our next question is from Jerry on YouTube. YouTube is on fire this evening. The questions seem to be all coming from YouTube. Jerry's saying, hi Saj, I have a landlord who wants to sell his tired 8-bedroom HMO in Edgbaston, Birmingham. It used to be a RSL in the past, so not loved. Should I, oh, we lost the question. Just get that question back. Thanks very much. Should I source it or JV? Would HMO planning and license be an issue? So that's a great question. Let's leave that question on the screen for a little while, because I just want to break that down a little bit, because there's some important points mentioned there. So there's a few things to pick out from that. So your ultimate question is whether you should source it on or joint venture with it. Well, that ultimately comes from what you want to be able to achieve from the transaction. So for example, if you're looking to build assets up for the longer term, you might partner with somebody who'll put the funds in, or maybe you put some funds in, somebody else will put some funds in, and you can add this to your portfolio as a property, 8 bedrooms in a in a good location in Birmingham, should cash flow quite well. On the other hand, you could source it on and take a fee. So when I first started in property many years ago, what I was doing was sourcing great deals and selling them on for a fee, £2,000, £3,000, £4,000, that sort of range. I'd find a good deal and I'd pass it on to somebody for a fee. So I'd take that fee once and I'd pass somebody a deal that'll make many, many thousands of pounds for it for many, many years to come, and potentially tens of thousands of pounds equity in that deal, all because I gave it up for a few £1,000s. Now, at the time, I just needed to build up an income, so I was quite happy to do that. But as soon as I was able to, I started partnering with some people to keep some of those deals, to start building a portfolio rather than being relying on those few £1,000s from the sale of a sourced deal. So think about what's more important for you right now. Jerry, is it about building the portfolio? Is it about getting that cash flow? So that's what I would say in terms of what you should do with it. A few other points that I want to pick out from this, which is quite important. So if it's an 8-bedroom HMO, so its planning classification should be sui generis. So it's a class of its own, which should be, what that means is that it should have established use being used as an 8-bedroom HMO if it's been the case for many years. You could check it on the planning portal to see if there's been any previous planning application, or you could check with the council. As long as it's got history of being running like this for a period of time, you can apply for established use as well to say it's an existing HMO. Then the fact that it's being used by an RSL. Now, RSLs, a registered social landlord, even the rules that apply to them are a little bit different to us as individual landlords that are going to, for example, run HMOs. Now, they don't need to license their houses, so it may not be that there's a license that existed for that particular property. So you may be falling into a little bit of a grey area in terms of whether it needs planning or it doesn't need planning to be able to operate as a HMO. Now, let's say, for instance, they said I've come across a few of these properties where it may have been used as a HMO by an RSL in the past, but actually that doesn't constitute the fact that it's established use as a HMO to be used for, say, professional tenants or students. So it can be a little bit of a grey area, and that's something you need to look at to make sure you can run it as a HMO, because that's where its value will be as because Birmingham is now Article 4. So Jerry, I hope that helps. I hope that answers your question. I'm always interested in deals in Birmingham, so happy for you to ping me some details and we can have a chat about the property, and if it's one we might be interested in looking at with you, or maybe even buying it from you as a source deal if the numbers stack up. Just on that point, I mean, the way I've built my business is really partnering with other people over the years who funded deals. So I say I use my time, skill, and experience to find fantastic property investment opportunities, and I partner with people who've got the cash, and then we share the rewards. Now, generally, people invested with me in two ways. One is that they're either lending money for projects, which is essentially a loan, or the other way is they're partnering in projects in terms of a joint venture. If you're interested in those things, ping me a message and we can talk more about how we can work together. I still today, with all the projects we do, work with other people's money in terms of growing that business and producing a great return for myself and also the investors that work with me. So the next question we have is from Ricky. Can you make sure that everybody still alive on LinkedIn and Facebook? Because we're not getting any questions from LinkedIn, Facebook, and Twitter and Instagram. And where are you? If you check on Instagram as well.
You're working.
Fantastic. Okay, so let's do this question here, which is on YouTube from Ricky. Hi Saj, I buy a property to do a flip or BRRR. Will I still pay stamp duty? I don't currently own any property. Great question there, Ricky. If you're buying a property with the intention of flipping it on, or using it as an investment property, a buy to let as it were, then you'd be paying stamp duty on that property because it's an investment property. If on the other hand, you are purchasing a property to use as your home, there'll be no stamp duty that you're paying depending on the figures. You're not paying the extra 3% anyway that we pay as investors. But let's say you do the property up, you stay a little while, you change your mind, your circumstances change, you decide to move on and sell that property, you won't have paid any stamp duty, and also you won't be paying any capital gains tax either because it's your primary residence, so there's no tax to pay there as well. So the benefit of that is that actually if you don't already own a property, I'd encourage you to purchase a home first that you may move on from in a little while, which you're perfectly entitled to do. Means you can keep that profit without paying any tax on it, and of course you're not paying the stamp duty as well. So that's something to be mindful of. So just looking at the time, let's see how many more questions we're getting. So we have a question on LinkedIn, and we have a question from my friend Mustafa, who is actually an administrator. He's saying, not true, as an IP, which is an insolvency practitioner, I'll always seek full market value. So thank you for that clarification. So Mustafa is an administrator that will dispose of assets that they need to get rid of. So if you like, their answer from the horse's mouth, their objective is always try and obtain the full market value because they're trying to realize that cash to repay those debts. So thank you for that, Mustafa. And we'll take this as the last question for today, which is on Facebook, and it's from Basil. What is the average expected net yield return for a HMO? I guess, Basil, this is one of those things of how long is a piece of string. Is very difficult to answer that question because there's many factors to take into consideration. So if I look at the net yield on our HMOs, it'd be quite low compared to some other people. So let me give you some context around that. So you could purchase a property, say for £150,000, and you could spend £20,000 on making it compliant as a HMO, fire doors, fire alarms, and then some basic furniture and letting it out. So your spend might be £170,000 plus some other costs. Now, then on the other hand, you could purchase something for £150,000, but you may spend £100,000 renovating it, making it a premium product, all singing and dancing, ensuite, modern tech in that, to be able to achieve a premium rent, but your premium rent may be a bit more than the other person achieving on their £170,000 investment. However, what you will have achieved, and the way we tend to do this, is you end up with a product that will have a very good commercial value. What we mean by that is if we go to remortgage that property, we will get a valuation based on its income rather than just bricks and mortar, which ultimately leads to us being able to extract a lot more of the initial investment, if not all of it, from that transaction. So although the net yield may be lower, the return on cash employed, or the return on cash, is much, much higher, if not infinite, because you've extracted pretty much all your money out of that transaction. I hope that made sense. I'm not sure I explained that so well, but hopefully it made some sense. So I just want to say thank you so much for taking the time to watch these. Remember, I'm here every Monday evening at 8:30 to answer your property investing questions. Make sure you get here nice and early on Facebook, YouTube, LinkedIn, Twitter, and Instagram, and our videos that go out regularly on YouTube as well on various topics, and also on my vlog as well. So make sure you subscribe to that, and I look forward to seeing you here same time next week. Thank you.